Looking for beyond ordinary investment opportunities? Global X ETFs is here to help with their suite of thematic, income, commodity, and digital asset funds. Explore the range at globalxetfs.com.au. And now, on with the show. How are you now? Broadcasting from the city of Sydney at Martin Place in Sydney. You are listening to The BIP Show, Season 7, Episode 2. We are sponsored again, as mentioned last time. Thank you to Global X for all they've done, and a reminder that the financial information found in this podcast is general in nature. Only speak to a professional advisor about your needs. Speaking of which, I am James Whelan, Investment Manager at VFS Group. Today, I am joined by Allan Gray, Managing Director, and CIO Simon Mawhinney. Simon, how are you now?
Very well, thank you, James. Thank you for your time.
Good of you to join us. Now, I was going to open this story with the UBS garbage bag story. I'm not going to do that because I don't want to take up your time with a hilarious yarn about my time when I was at UBS. But there is, I'll leave it for the end of the show. I'll tack it in at the end. If you want to stick around for it, then you're perfectly welcome to, Simon. Thank you very much. But let's just get straight into it. In the last podcast, your performance. So this was the last time we spoke was last year, about midway through. I think that the COVID effects were just sort of wearing off. I remember you were wearing a mask when I saw you come into the room. Everyone was still a little bit cagey about what was going on in that particular part of the world. We're still on the other, just coming out the other side of it. Your performance had, after a few years, obviously, of being a little bit behind a crazy market as it was, which I would be surprised if it wasn't, your performance did start to shine through and has continued to shine through now. How have you found the last 6 months with your style of investing?
The 6 months have been good. The last 6 months have been good. I guess, again...
Feel free to crow the performance if you want to do that. I mean, it's your story.
Well, I mean, how do you be one of the best performing fund managers over the last 12 months? And the way to do that is to be one of the worst performing fund managers over the 12 months prior to that.
Correct.
And that is what happened to us. I mean, we weren't the best last year, but we weren't the worst the year before. But we did have a particularly bad COVID drawdown. And we've fought our way through to a position now where, unfortunately, whilst not awful, we've pretty much just washed our faces over the last 3 or so years as these techie, momentum-y, new age companies fell out of favor and old world free cash flow positive earnings generating companies became back in vogue. And that coincided with the rise in interest rates. But yeah, so I guess it's just the fundamentals have taken hold again. It's not nice when market participants start ignoring them because we're fundamental investors. But from time to time that happens, and this was a particularly big drawdown for us. And yeah, the last 12 months have been a ray of sunshine.
Do you think it's going to be able to continue with the direction that the market is taking at the moment?
Yeah, so the market now is incredibly strong. And if anything, some of those growthy techie names, if you look at things like Tesla, are rallying back again. And so if anything, there's a few headwinds that have presented themselves. And I think the reason for that is some concerns around, I guess, the economic cycle. And many of these cash flow earning companies are quite cyclical in nature, but also if the economic cycle turns down, there's this view that interest rates will fall again, and then all of a sudden long duration stocks with uncertain but distant earnings are worth more than they would otherwise be if you were discounting those earnings quite a lot. So I don't know is the answer to the question, but there is a huge disparity of value in the stock market at the moment. And so if you were to say over the next 5 years, do I think it'll be good for our investment style? I think absolutely. What happens over the next 6 days or 6 months is very hard to tell.
Yeah, I can't tell that. And the long-term investors, I don't think would be able to tell that either. I'd probably hope not, actually. That's if you're focusing on the next 6 days and you're not focusing on the next 6 years, I think that's the way that goes.
Yeah.
Leave the 6 days to me. Now, there's a few things that I wanted to get back to. We'll get back to the disparity of value in a moment. I wanted to talk about, so let's just say that you're the contrarian. Let's just say you are the contrarian investors, and you want to invest in companies with lots of cash. Putting it simply, putting it cash flow. Wouldn't that put tech into a spot? Certain areas of tech. You've got Apple, which is one of the biggest cash flow generators ever in history. Google, same with Microsoft. Would that put them in the sweet spot for you a few months ago to have a look at when they were completely unloved at that time?
I would say yes, obviously outside my immediate investment universe, seeing as where Australian equities focused. But you've just mentioned three amazing companies with worldwide franchises, which in the fullness of time will have businesses that I think are probably stronger than today's. I think all three of those are prone to an economic cycle. I mean, they're not only tech companies, sure, they're tech enablers, but they're also consumer products companies now as well. And so there is an economic cycle to which they're exposed. But yes, those did fall down quite a bit. And I know our sister company Orbis has at least one of those did start to invest in one of those. So yeah, it's not surprising. I think that value investors around the world have found those somewhat attractive, or more so than they were.
Yeah, probably a lot of regrets from people who didn't grab them at those levels. I think personally there's still some good opportunities around, especially in those spaces. It's there. Now, speaking of which, a lot of people are sort of hesitant with what's coming up with the Fed. Every single Fed conversation seems like the biggest Fed conversation in the world. I'm not going to ask you about that, but I am going to ask you about where, over a longer term, you see the cycle sort of switching over the next few years. Do you think that everyone's talking about it. This is the most talked about recession in history. So much so, I think that probably it's now sort of become something that people have discarded and dismissed and even priced in. It has to be super deep for the market to really take notice of what's going on. How far do you think that this goes, and how long do you think it goes, and what do you think the ramifications of that are going to be economically? Don't worry about the market.
Well, can I go on a 2-minute slightly off-piste rant on this topic?
I'm going to move the microphone a little bit closer to you as you do that, please. Be my guest.
There's a book that was written called The Triumph of the Optimists, and it later became, I think, Dimson, Staunton, and Thompson, I think, are the authors.
Note that down.
And I think it's now no longer published, but Credit Suisse has bought it, and I think it's now the Credit Suisse annual yearbook or something, I don't know. But it looks at the growth of various countries and the stock market returns. Mm-hmm. And so I think everything's on a per capita basis. Everything is adjusted for inflation. And when the book was first published, that 100 years of data across a number of countries, Australia being one of them. And now we're on to around 117 years. So it's been 17 years since it was first published. And there is, according to this data, irrefutable evidence that there is no correlation between per capita GDP growth and stock market returns.
Oh, finally. Okay.
And I said 2 minutes. I probably took a minute. And if that is true, and it is true, then the converse is probably, or must be, true. And that is, if there's a negative GDP per capita shock, a recession, then in and of itself, it has nothing to do with the stock market return, and stock market return should be uncorrelated to that. So the answer to your question is, who cares from my perspective?
Very good.
But of course, there's a lot of emotion that drives stock markets in the short term. And I think fears of a recession are some of that. But if that has driven the stock market price, I haven't seen it, because of course we're sort of almost hitting new highs every day. And it's not clear it's going to do anything. And the reason economic weakness is good for incumbents is that it doesn't attract competition. High growing companies, industries, countries attract a lot of competition, which erodes returns, which reduces returns to shareholders, which is not good for share prices.
So if the recession doesn't, so top line, it doesn't affect the actual top line of a stock market. If you look at that one number of the S&P 500 or the XJO, that's the top line.
Well, it does affect it, but it's an emotional effect. It's not an economic one.
Not an economic one. But there's certain sectors that would rise and certain sectors that would be disintegrated as a recession does take hold. We saw COVID. If anything, out of COVID, we didn't see the sectors that probably should have been left to the wayside get left away.
Yeah,
and we probably saw a lot of sectors that probably shouldn't have grow too much. Do you think that at what stage? Actually, let's just sort of let's go really off piste. What needs to grow and what doesn't need to grow? We're a bit out there. Where does the world need to sort of take the direction that you see?
Well, I mean, 200 years time, I think our population needs to be half of what it is today to sustain ourselves. We can't keep growing like we are. And especially if everyone wants the world to be a less carbon emitting place, we can't keep growing the number of people on the planet. But in Australia, there are imbalances that are causing societal issues like house prices. We've had a small correction, but it's small. Too small. It's bigger in real terms because, of course, we've had inflation of 10 or so % since the peak in house prices. And it's not clear to me that a nice but somehow protected recession wouldn't bring some cathartic outcomes that the economy needs. There seems to be some capital that's misallocated. And of course, if this does happen, you don't want to own too much consumer discretionary stuff. But then you look at the consumer discretionary companies in Australia, and they're just consistently outperforming with revenue growth. And so I don't know who it is who's visiting JB Hi-Fi and buying new computers every week, but it's happening.
I think that there is a lot. I'm looking at my JB Hi-Fi and Harvey Norman, which I hate as well. Sorry, not as well, but I dislike it along with a fair few people in the market, and they've been stubbornly bullish. I think that the economists that we've had on have said that the end of last year was the last hurrah for our spending, and now money is definitely being tightened. Belts are definitely being tightened, and people are being a little bit more restrictive on where they're spending. Do you think that that's probably the way that the Australian consumer is looking at their spending for the next 12 months or even longer than that?
Maybe. As it happens, the ABS retail sales numbers came out today. And
I was hoping that you touch on that.
They weren't very good.
No, they were not.
but then we had the December sales were after a bumper November, and all of these Black Saturday or Super Tuesday or Manic Monday, whatever the things are called, they all happen in November now. And so maybe it's just shifted the retail cycle forward. And so it's not clear to me that the way the ABS seasonally adjusts these price series is that it captures that kind of dynamic. But mostly, even though there was a pullback in December, retail sales in December were 7.5% above the levels that they were a year before. And that's quite, okay, it's not as much as inflation, or it's in line with inflation. So maybe that's just normal.
That's right. Okay, that makes sense. That makes sense.
So, but it's not a pullback. It's not a reduction in real terms, which is what you would expect if consumers were tightening their belts. So to the extent that it's happening, and your economists are right, we haven't seen it come through the data yet. It would be hard for me to imagine it wouldn't ultimately manifest itself in the data.
It has to, even if it's. I mean, there's been speculation that the sales mean that quantity will still remain high, even though the price of things has actually dropped. So potentially we'll see that inflation will come down and the price of actual goods that you need to buy will come down, but that spending will still stay high because, well, it still puzzles me how many laptops people need to buy and things like that. But JB Hi-Fi is they've dropped prices completely across the line, so much so that it's almost crazy for you not to buy that TV or laptop now if you can afford it, because you're not going to be able to see those prices again for another, well, who knows? If it's coming backwards.
I'm not close enough to JB Hi-Fi's prices. I know that every time you walk in there, they give you the perception that they're dropping their prices.
That's not too bad. Now, okay, so let's get back on. We've talked about the cycle. You mentioned the disparity of value. How big are the gaps between cheap and expensive stocks at the moment? Or where is the disparity?
Quite big. Not as big as it used to be, because, of course, you've seen some of the techie, growthy areas of the market pull back a little bit together with consumer staples, which have been safe havens, and some of the more cyclically impacted downbeat companies like, say, energy, rally a bit. And so that's narrowed the gap. But there is and in Australia, no one really cares about the tech sector because it's pretty much 4% of our stock market. It's tiny. We're not talking about the Goliaths that you mentioned earlier, but the healthcare companies, they're in the mid to high 30s, some of them in the low 40s times earnings. And you have on the other end of the spectrum, energy at less than 10, materials near 10 times earnings. You have consumer staples in the mid 20s. You have some crazies out there, the really, really, really crazies. They exist everywhere that are on high multiples of earnings, which probably will never eventuate. And so effectively bankrupt companies that have sold a great story.
Yeah. Are you allowed to name any, or is it just something that you just,
well, I mean,
what's in your untouchable list at the moment? I mean, it's
well, I mean, I'm going to respect the investors who've chosen to allocate capital to those and not mention them.
Good answer.
But
Good answer. My phone does tend to ring whenever someone says something very controversial like that. So,
No, I'd rather not say. But of course they exist, and from time to time we may even get stuck with one of them. Who knows? But hopefully not. But so we're talking about some companies out there trade at very high multiples of earnings that actually aren't low. Buying a company at a high multiple of earnings is not such a bad thing if those earnings are depressed.
Mm-hmm.
But there are earnings out there that are not cyclically low. Think about the healthcare companies. In fact, some of those have really benefited from COVID and are now beginning to pull back in terms of the level of earnings, yet the multiples are still very, very high. And then I wouldn't have thought Woolworths, Coles, and the like, Wesfarmers. I don't think their earnings are low. In fact, if anything, parts of Wesfarmers' earnings are very high, if you think about Bunnings. Yet you're paying really high multiples for these companies in the mid-20s. And then there's the other end of the spectrum where you could definitely argue that the iron ore miners don't have low earnings, but you do pay a low multiple for them. And so you need to make this adjustment. What are normal earnings? And so everyone seems to obsess about, if there's a recession, company ABC, bad choice of letters, say BHP's earnings are going to fall. Okay, So what? Well, how much do I pay for that today? The fact that they're going to fall doesn't mean the price I pay today is too high. Now, we don't own BHP, but it's an example. It's only half of the battle is knowing which direction earnings will move and what level they'll settle on. The other bit is making sure you don't lose sight of the price that you pay today and whether it already discounts that.
If it actually makes sense.
Yeah,
okay.
And we think in a number of energy companies it does. Some of the materials we think they do.
So you mentioned energy. I'm going to ask you one question, then we'll be able to get around. You'll see a segue, which is actually I've just come up with now. So let's just stick with it here if we can for half a moment.
G'day, it's James here. We're going to take a quick break from our chat with Simon, but take a break from vanilla ETFs and discover Global X's innovative funds and industry-leading research to back your investment ideas. Learn more at www.globalxetfs.com.au. Now, back to the show.
Energy. So the Chinese reopening, you mentioned BHP, you mentioned iron ore. One of the biggest probably influences on us for the next 12 months at least is a Chinese reopening. How much is that factoring into your decision making now? Because it has to be a long-term situation, the China reopening, and where they're moving into and its influence on the Australian market.
Yeah, so I think the bit, when you say reopening, are you talking about COVID reopening or trade tension reopening?
I'm a little bit of both at the same sort of time. The COVID reopening has provided a big sugar rush.
Yeah.
But where do you factor in the trade tension, that easing of that?
Yeah.
Keeping in mind that there's a presidential election in 2024.
Yeah. So the COVID reopening, I mean, surely we all knew that was going to happen. It's just a question of whether it happened now or in 6 months' time.
It took 10 minutes instead of 20 minutes.
We've been down this path a few times for a few countries, and all of them have ended up in the same way: reopen. So that was going to happen, and so I don't think that has or shouldn't really have caused the dial to move that much. And then the trade tensions. Yeah, I wonder. Where were the depressed earnings that came about as a result of the trade tensions? And let's put aside all of the companies that sold Penfolds to China. So they Treasury Wine have had to reinvent itself. Some of the farming community have had to do the same with, I think barley was one of the ones. So no listed barley company. So, okay, we don't have a data point there. But if you think about all of the others with the trade tensions, the iron ore miners, well, China never really shut that off because they need them. Coal, they shut them off. Yeah, where were coal price? $300 a ton.
Yeah,
these companies are making off like bandits. So the trade tensions and the closing of China did not hurt these companies. Why is it that the reopening is going to benefit them so greatly? And so I think it's mostly a non-event.
Okay. Oh, that's a good answer. Now, okay, because we mentioned China, we've mentioned energy. How does ESG factor into any of the thinking that you've got in that? Obviously, it's been a hot topic. It was a hot topic. It was easy to do ESG when the market was running hot. We saw a huge rationalization at the beginning of last year with the invasion of the Ukraine, because then all of a sudden people realized that you can't invest in ESG when energy is running that high, and all of a sudden you're underperforming. There's 1,000 different reasons for that. The speculation that potentially investing in weapons manufacturers could have been classed as ESG to secure energy future and sustainability. That was a little bit silly at the time, but it was definitely something that was speculated by fund managers overseas. How much does it factor in for Allan Gray thinking?
Well, I think you've posed the question in a way that implies that energy companies are ESG poor or carry a black mark against their ESG rating, and I think that is unfair.
That is a good answer. I did pose it like that. That's right.
And of course, I think the big thing that's changed in ESG over the last, say, 5 years is it's just become E. So whenever someone mentions the letters ESG, they're really talking about greenhouse gas emissions and not much more. And I think there is an increasing realization that the energy transition is real. There's an affordability outcome that needs to be taken into consideration. And I do feel that on the E of ES&G, that the market is becoming a little bit more balanced, as opposed to having shot from the hip initially, which was, sell all hydrocarbon producing companies. We don't need them. They are the Antichrist. That narrative doesn't exist any longer.
No.
But the ESG focus, rightly, I think, remains and will continue to thrive. And from our perspective, because you did ask how Allan Gray looks at these things, but the value of every company, doesn't matter what they do, whether they make exercise bikes that become long-term coat hangers in your living room or extract oil and gas, the value of those two companies on the opposite end of the spectrum are the same, and that is the present value of the future cash flows that they generate. And in order to be able to discount some future cash flows, you need those cash flows to be sustainable. And in order to be sustainable, well, I mean, the rest is obvious. They need a social license. They need to do things that people need, and they can get disrupted. Then, of course, the earning stream is finite, and the discounted cash flows end up being low. So those are important aspects of the whole valuation process. So I don't think there's any successful investor that can exist for long, or any investor that could have a successful history if they ignore the sustainability of the cash flows that the companies they invest in are likely to generate. And so that's sort of the lens that we take to ESG. We spend a lot of time on it, but for us, it's not a gate you need to walk through. I mean, there can be companies that are particularly poor on various ESG metrics, but the price that is on offer is so attractive, it makes sense to buy the company and agitate for change.
Yeah.
We're not a shareholder in AGL, and I'm pretty sure the AGL board would have told me to press on if I tried to weigh in on the debate with AGL and Grok Ventures or whatever it was. The only people who had a say were the people who had a seat around the table, and the only people who had a seat around the table were shareholders.
Yeah.
So you can only advocate for change, improvement from the position of ownership. And so we don't have a divestment approach to ESG.
It's funny that you mentioned that, and thank you. That's a good answer, and probably one of the most valid ESG answers that I think that we've heard maybe in the last 12 months. Amazingly, I'm not big on it. I'm big on trying to uncover exactly how much of it was just pushed on people as being a bit of a sham, And now sort of we're seeing the reckoning in it, and people actually making sensible decisions in things about saying, I may have more influence owning this than being on the outside complaining about it or by not owning it. And I think that it's funny because I saw a Financial Times headline this morning talking about passive investors being a little bit more active when it comes to the decision-making process and where they've got potentially a conflict that's going on there. Do you think that we're going to see more of a rise of that active investor actually coming and weighing in? We've already seen a few activist investor moves in the last couple of months. Do you think that we might see more with regards to agitation?
It would be nice, actually.
Yeah, okay.
I think it would be not just from an ESG perspective across all aspects, and well, the governance part of ESG would be a good place to focus.
It would be a lovely place to focus, trust me.
But there is a lot of apathy out there. I sense more so in Australia than in places like the US, which is almost the home of these activist investors anyway. I would put us in the category of more active than normal in terms of agitation. And we really, really struggle to effect change or implement change or bring about change, even for companies where we own more than 10% of the issued capital. And
really?
So it is hard. Yeah.
Really? That's actually, no, I won't ask you that. I was going to ask about sort of how much influence you could actually have in certain companies, like how often they'd be able to take your call. They'd always have to take your call, wouldn't they?
Well, we're a reasonably low-touch investor. You don't want the management teams and boards that you've tasked with stewarding your capital to have to blow smoke up an investor's backside 24/7. So
just a little bit.
So we are low-touch, and I guess then when we do touch, we hope that people listen and it is a bit more impactful. But there have been occasions where we have really struggled to make change. I mean, AMP of 5 or so years ago was a classic example. It was very difficult to bring about some of those changes. We've publicly made some statements around what's happening at Incitec Pivot that we've been unhappy with, and we owned well over 5% of the company, not over 10% of the company.
Yeah.
And, it's not clear how successful we'll be with that, and we're in the process of writing a letter to Newcrest's board, and we own more than 5%, but slightly less than 10% of that company. And I'm not sure how successful we'll be there, but we certainly will try. But it is hard to. So welcome anyone who wants to employ activism in Australia. I think it'll be a good thing. But everyone does see the world through a slightly different lens, and everyone has a different time horizon, and so it's not clear that activism itself would be a good thing, because it might just it might bring about sugar hits for certain companies, and these activist shareholders can sail off into the sunset quickly.
Yeah, with what they need, and then off you go. There's no lockdown. There's no locking someone into a shareholding.
Precisely. Yeah.
I've made your change. You got the 10% you wanted, and now off you go, and we never see you again. And then you're probably going to see boards. And
then the board and the management team are left holding the can.
Yeah.
And the rest of the shareholder register.
Yeah.
So.
Yeah, just simply because I could see that. Then you've got a board who continually has to answer the call from you guys and has to continually try to make you happy. Yeah. Instead of actually running the company.
Exactly. I mean, we are glorified pen pushers who sit behind a monitor and an Excel spreadsheet.
Now let's get on to that, because we're about close to wrap up. I know that your time is limited, and so thank you very much again, Simon, for joining us. We didn't get a chance to touch on who you are and how you applied your trade, where you've come from. Do you want to give us a little bit of an overview of sort of where you came from, where you learnt what you learnt, and how you where you developed the expertise that you have, if that's okay for you to go into?
Okay, sure. So I came to Australia in 2001, and I'm the son of Irish parents, but we grew up, well, from a young age, we moved to South Africa. And when I first came to Australia, I came on a holiday visa, and I got what was then a 457 working visa at Macquarie. And it was only then that I really started getting quite interested in financial markets. So not that long ago. I did own a few shares beforehand, and I was more a very mainstream investor at the time. I would read what other people write. I'd be very heavily influenced by what I read in the newspaper, and I just went with the flow. I was a very consensus kind of investor. If lithium is going to go up in demand a lot, these lithium companies are the ones to buy, and I would buy them.
Yep.
That was then. And then through it was only 2 or so years at Macquarie, I was working in what at the time was called, or a part of the group that was supporting what was called Equity Markets Group. And the stock market in Australia, it was my first exposure to anything in Australia, but also to the stock market in Australia. And I began to start following a few companies a little bit more closely, and then decided I wanted to do the CFA program because I wanted to move into research. I'm an introvert, and I think research suits my personality, and I happen to be interested in research as well. So, it was a win-win. I did my CFA, and I actually really struggled to get into the industry. I'm not sure whether I was knocking on the right doors or recruitment agents is what it was. But then I met or was introduced through a recruitment agent to Simon Moret, who in 2005 came out to Australia. He had been the chief investment officer of Allan Limited in South Africa, and then our sister company, Orbis London. And he had decided that he didn't want to raise his family in England on the Mud Island for obvious reasons, and came to Australia and set up what was then called Orbis Investment Management Australia, but now called Allan Gray Australia. And yeah, I just, I guess a lot of people say things like this, but it was a bit fortuitous for me because there was a lot to do at the beginning that he didn't want to do. And so I just passed my CFA exams or became a charter holder, and I wanted to do research. And he said to me, you can do research 50% of the time, and the other 50% of the time you need to help set up the business. And that was, getting our PDS, getting our financial services license, setting up,
getting the AFSL amendment, things like that.
All of that stuff, client services, legal, make sure all of it. Apparently it's gotten easier, but I don't know.
Not while you're doing 50% research though, but it's okay.
So, and I thought, okay, well, 50% research is better than none. And he said, I'll give you a 2-year contract. And at the end of 2 years, one of a number of things will happen. Either we're going to part ways because I don't want you, or you're going to have to choose between a research role or sort of a more business role. And then 2 years came up, and we hired another person on the business side, and I could start moving more and more into the research, almost exclusive side of things. And that was by 2007, 2008. And then the financial crisis hit. And then, and then unfortunately, Simon passed away in February 15. 26th of February 15. And yeah, that's unfortunately, if anyone had ever met him or seen him, he was a very tall man with very big shoes, literally and figuratively. And our business was, we were not ready for that. And so it was quite a tumultuous period emotionally and just from a business perspective. And we at the time were going through a similar drawdown in performance then to the one we've just recently come out of in 2021. So yeah, all in all, quite a baptism of fire. Some of it I look back on fondly, but most of it I look back on and say, hopefully never again.
Well, that thank you for sharing that with us. But just in the journey and where it came from, and I've heard Simon mention in revered tones of just about what a legend he was.
Great man.
So, that's thank you so much for that. Look, I'm not going to take up any more of your time for that. Thank you so much for joining us today and the insights that you've given us. Simon Mawhinney, Managing Director and Chief Investment Officer of Allan Gray. Oh, now there was something else. So to access the funds, you're available through M funds. You've got a balanced fund, a stable fund, and
just an equity fund, and just straight equity,
and the straight equity fund as well. All available on the managed funds platforms that anyone can get access to as well. More information will be on the website for anyone who does want access to, and I strongly suggest that you actually check it out because some of the people that I trust almost with my life and my finances recommend you so strongly as well. That's the sort of the faith that the smartest people in the industry have got in you. So that's coming with some pretty revered tones for yourself as well. Now, okay, so thank you very much for joining us, Simon Mawhinney, Allan Gray. Cheers for that.
Thank you very much.
You can find us on iTunes at The BIP Show or wherever you get your podcasts. We're on Twitter at @the_BIP_show, and we're on Facebook too. Just search for The BIP Show. I've got a website. Just Google Whelan Capital. It's got all of the links and all of the documents that you want to know. Individually, I am at JamesWhelan42 on Twitter. The show is produced by whoever I could find on the day. Thank you very much. We'll catch you next time.
This episode might be over, but your ETF investing journey with Global X's is only just beginning. The expert team at Global X ETFs is ready to support your goals with their wide suite of ETFs. For the latest updates, follow Global X ETFs on LinkedIn and Twitter at Global X ETFs Australia.
Hey everyone, it's James here. Really quickly, thank you for listening to the show, and thank you for all of your support that you've given me through the year. Merry Christmas and a Happy New Year. Just a note also, I am hosting a webinar in February next year. It's going to be jam-packed, an hour. It's online. Lots of guest speakers have lined up already, and it's going to be great. So if you could show your support, get behind that one, and click an RSVP. It'll be a great sign. It's going to be a great night. I'm really, really looking forward to it. So thanks, guys. But for now, have yourself a great break. If you're taking one, Merry Christmas, New Year. Stay safe.